Okay, homework for learning objective 3. Let's cycle through these. When creditors who relied on an entity's audited financial statement suffer monetary losses after a customer goes bankrupt, what must the plaintiff creditors in a lawsuit for damages show in a court that follows the doctrine of credit alliance? And again, that is that the auditors knew and specifically acknowledged identification of those creditors. So that's one of the additional items that the plaintiffs must demonstrate. Which of the following third parties is known by name to the auditors as the audit is conducted? And that again is a primary beneficiary. Which of the following cases provides auditors the broadest exposure for third parties? And again, that's Rosenblum v. Adler. A group of investors sued Anderson Olds and Watershed for alleged damages suffered when the entity in which they held common stock went bankrupt. To avoid liability under common law, AOW must demonstrate which of the following. And the best answer is going to be that the audit was conducted in accordance with GAS and with due professional care. If a company, or excuse me, if a CPA firm is being sued for common law fraud by a third party based upon materially false financial statements, which of the following is the best defense the auditors could assert? And the best answer, again, you have to think about what they have to prove in terms of fraud. The best answer for this one is going to be reliance, because that's a necessary element of proof. C65, auditors may be liable to third parties for fraud in several ways, and so they want us to answer the following questions. So first, identify auditors' liability for fraud to third parties, and that is pretty straightforward. We discussed this in the lecture. Auditors will be liable for fraud to all third-party users of financial statements under common law or statutory law. So for fraud, third-party distinction isn't important. Distinguish between fraud and constructive fraud. And again, the primary difference between those two levels of professional care is knowledge or intent that is present for the auditor. What is the auditor's liability for constructive fraud? Auditors will be liable for constructive fraud to third parties under both common law and the Securities Act of 1933. To be held liable under the Securities Act of 1934, that is the anti-fraud statute, intent generally must be shown. And again, intent being scienter, which is not always going to be present in cases of constructive fraud. So in general, people bring suit under the 1933 Act for everything. The 1934 Act is generally fraud, although subsequent cases have clarified that gross negligence is also an available option under the 1934 Act. And we'll talk more about that when we get to the next two learning objectives. In your opinion, is auditor's liability to third parties fair? You're going to say, yeah. I mean, if you're intending to deceive people, you should probably be held liable. And again, while intention isn't present under constructive fraud, that's a reckless level of care, and it probably makes sense that if you're that reckless, you should be liable to someone for your behavior. C66, during the audit of Health Management's 1995 financial statements, 1.8 million of inventory in transit was included on the balance sheet. The auditors never obtained evidence of the existence of this inventory, even though several questions had been raised concerning an excessively large amount of inventory in transit at the end of the year. In 1996, Health Management announced that it had discovered a series of accounting irregularities. Do legal grounds exist to claim that the auditors committed fraud? In this case, no, probably not. To show fraud, you have to show that they were aware of the inventory amounts were incorrect and then not require an adjustment. Neither of these are really shown from the information. The failure is at least ordinary negligence. Is probably more likely to be gross negligence, given the fact that they were at least aware that it seemed like an unreasonable amount. What would be the auditor's defense if such grounds did exist? And you say, well, if it did exist, they could argue due diligence. If they performed their audit of inventory in accordance with gas, they could say causation, that management perpetrated the fraud, which include the objective of defrauding the auditors, and they could always argue good faith. So if someone's suing you for fraud, you could say there was no intent. So that's always an available option. For C67, uh, an accounting firm was engaged to examine the financial statements of Martin Manufacturing Corporation. Martin needed the cash to continue its operations and agreed to sell common stock to an investment in a subsidiary through a private placement. The buyers insisted that the proceeds be placed in escrow because of the possibility of a major contingent tax liability that can result from a pending government claim against the subsidiary. The payment in escrow was completed in late November. Martin's president told the audit partner that the proceeds from the sale of the subsidiary's common stock held in escrow should be shown on the balance sheet as an unrestricted current accounts receivable. The president held the opinion that the government's claim was groundless and Martin needed an uncluttered balance sheet, whatever that means, and a clean auditor's opinion to obtain additional working capital from lenders. The audit partner agreed with the president and issued an unmodified opinion, like a dope, and on Martin's financial statements, which did not refer to the contingent liability and did not properly describe the escrow arrangement. The government's claim proved to be valid, which of course it did, and pursuant to the agreement with the buyers, the purchase price of the subsidiary fell. This adverse development forced Martin into bankruptcy, which of course it did, and the accounting firm is being sued for deceit, fraud by several of Martin's unpaid creditors who extended credit in reliance on the unmodified financial statements. So, what deceit or fraud do you believe that the creditors are claiming? Well, the creditors are saying that the auditor knew that the financial statements were not in accordance with GAAP, especially as it related to this escrow account and the entire arrangement, and that appears to be the case. So the notes, in addition to the face of the financial statements, the notes are part of the financial statements. So at the very least, this arrangement should have been disclosed in the financial statements. Is lack of privity important in this case? And the answer is no. So again, if an action is based on fraud, privity is not important at all. Auditors are going to be liable to anyone who they harmed or that were harmed as part of the fraud. Do you believe the accounting firm is liable to the creditors? Explain. Yes. I mean, the firm is liable to creditors because the firm was aware and they went along with it. And so there was clearly an intent to omit this material information. So it appears that they would be. So that is it for learning objective number three's homework.